Welcome to Thoughts on the Market. I'm Andrew Sheets, Chief Cross-Asset Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about trends across the global investment landscape and how we put those ideas together. It's Friday, March 27th at 3 p.m. in London. The best analogy I've ever heard for the importance of government action in markets goes something like this. Imagine you're watching a professional basketball game or whatever your favorite sport happens to be. Both teams are made up of generally good, generally honest, extremely hardworking players. They're also extremely competitive, and the prize for winning is high. Now imagine that game was played without referees. I think it's fair to say that it wouldn't work, and more likely, a normally good-natured, competitive event could get out of hand. I mention this because at the present moment, the referees are doing their best to sort out what's currently taking place in financial markets. How they go about that isn't easy, but it does matter for what happens next. In this case, when I refer to the referees, I'm referring to central banks and the governments themselves. The question of how and when these actors should intervene in financial markets is a question that goes back well over 100 years. Indeed, in 1913, the Federal Reserve was created to help prevent the types of financial instability that had defined the century before. Today, they face the confluence of two issues. First, the US and global economy are likely to go through a recession, the result of fallout from the coronavirus colliding with an economy that we felt was already showing many signs of fatigue. Secondly, the sheer uncertainty caused by these events has caused many investors to sell anything they can to raise cash. Both events have been contributors to the volatility we've seen lately, but they are very different challenges for those financial referees. The price of good assets being pushed artificially low because investors are struggling to raise money is an issue of liquidity. The market being worried about earnings declining and default rates going up due to weaker growth is a different question, a question of solvency. Generally speaking, central banks are much better equipped to deal with the former issue, liquidity. We think this explains the aggressive intervention into financial markets by the Federal Reserve, the European Central Bank, the Bank of England, and the Bank of Japan recently, interventions that have far exceeded anything we saw during the global financial crisis over 10 years ago. Concerns about the level of earnings, or cash flow, or default rates, in contrast, are much harder to address by central banks. Fiscal stimulus from governments will help, but in almost every economic downturn in history, default rates have risen and earnings have declined despite the best efforts of government stimulus. For investors, the fact that central banks can more easily address liquidity than solvency is a reason that we prefer markets where we think liquidity is the bigger issue. It's a reason we've upgraded investment-grade credit to overweight, but have only upgraded high-yield credit to neutral. Thanks for listening. For more video from Morgan Stanley, please subscribe here to our YouTube channel, or you can subscribe to Thoughts on the Market directly on Apple Podcasts or your favorite podcast platform.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.